Good morning, everyone, and thank you for attending our Reverse Inquiries Workshop, Sustainable Structured Products. I'm Brad Berman. I'm counsel here at Mayer Brown in New York. I'll be joined today by Patrick Scheuble, a partner in our Frankfurt office, and Steffen Scheuble, the Chief Executive Officer of Solactive, a leading index provider based in Germany. Before we begin, we'd like to cover a few housekeeping items. To ask questions, please use the Q&A widget on your screen. We will try to address questions throughout the webinar. Otherwise, we'll get back to you via email. For those seeking CLE credit today, please download the affirmation form and the evaluation form found in your resources widget on the screen. We will announce the CLE code once during the middle of the presentation. Please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget. We will also distribute these via email after the webinar. Patrick, over to you to start. Thank you.
Yeah, thank you very much, Brad, and hello from Frankfurt. My name is Patrick Scheuble. I'm a capital markets partner and the head of banking and finance of Mayer Brown here in Frankfurt. And I'm starting this workshop with the topic sustainability and structured products. I hope you're all safe, and given the current circumstances, I just wanted to mention that when we prepared, when we initially discussed to do this workshop, we were impressed by all the developments on Friday for Futures and all the other discussions about going more green, buying electric cars, etc. So that we also thought it's a good topic to think about when working on structured products. And now in connection with COVID-19, with the COVID-19 outbreak, it also becomes clear from the European perspective that sustainability is a critical need to tackle in the future, not only from a green perspective, but from an overall sustainability perspective. So what I want to do today is, first of all, I want to briefly outline what sustainability means in the context of financial products, give an overview of the market on sustainable debt investment and how it looks like, in particular here in Europe. Then I want to give a brief overview of the European upcoming regulations. We will see a huge development on a new regulatory requirement when it comes to sustainability, in particular to sustainable finance. And it's already now very complex, and it will be very complex in the future. And then I want to summarize all this, what it actually means for issuing and structuring structured products in the future, which will also be very then the link to my subsequent presenter, Mr. Scheuble from Solactive. And then I want to briefly give you an overview of the further developments. So, what does sustainability mean? Where it all comes from is back in 2015, where the UN decided on the 2030 agenda for sustainable development. This then resulted in the Paris Agreement, which was signed by the EU in 2016, and which gave the overall goal to meet the 1.5 degree goal of the Paris Climate Change Agreement going forward, so compared to a pre-industrial climate. In addition, in connection with the further development, the EU Commission published in 2018 a so-called action plan on the financial sustainability growth. This was all based on a high-level expert group strategy paper that should form the basis of the future action plan in the EU when integrating sustainability into finance. And finally, lastly, by the end of 2019, with the new Commission in Europe being elected, there was this European Green Deal published. So this all resulted in upcoming in upcoming more detailed discussions about how to regulate financial markets and its particular financings to increase, on the first hand, transparency for investors when it comes to sustainability and what does it actually mean and what are their ESG preferences and how can these preferences be met. It should in particular encourage capital flow into areas that promote sustainable development goals that are by the UN, and in particularly addressing the financial risks of climate change. It's also important, these goals also consider the risk management of financial market participants. And the other goal or objective that is part of this overall plan is prompting trust and integrity in the development of the sustainable finance industry. So what does sustainable mean? When we come back later to structured products, I want to set the scene with regard to sustainable finance from an overall perspective. I just want to make clear there is no uniform definition so far, which then results also in these regulations to make a more level playing field when it comes to this term sustainability. So what we often hear is the term ESG investment, and E stands for environmental, S stands for social, and G stands for governance finance. I show this on slide 4. With regard to green finance, we often see specific goals that could be addressed by financing certain activities, like reducing pollution or biodiversity, or to migrate or to adapt to to climate-friendly activities. What we currently see in terms of green debt investment are mainly green bonds with a green use of proceeds element. However, in the structured products area, we see some kind of green products that are linked to an index that features some green elements. Or in the future, we could also think about bonds linked to some kind of green performance indicators of an issuer. When it comes to social finance, this is a very hot topic at this point in time, and we have seen the very first social bonds that cover COVID-19 related financings. So this is another part of ESG investing, and finally governance finance. We also sometimes differentiate to impact investing. So when we think about impact investing, there must be some kind of direct financing related impact of the product, so that there is some link between the activity and the funds that will be given. A brief market overview, and this is from very German specific here at the moment, but in this slide, but we just want to make clear that we have seen an increasing volume of green bonds from many issuers, not only banks as are shown here on my slide, but also corporate issuers have used green bonds in the last years, in particular in the last 2 years, and also in the beginning of this year. And on the other hand, we see an increasing interest of investors, both on the retail and in its institutional side, in integrating their ESG preferences into their investment approach. With regard to structured products, we see an initial start of these, as I mentioned before, of structured products coming into the sustainability area. For example, we have seen a very first retail green structured product offering here in Germany in October last year, which was a very first issue that had a very specific use of proceeds section with regard to this investment. And in the past, we mainly have also seen structured products that were linked to some kind of green indices. the problem on this market is still that there's no uniform definition of what is sustainable, what is a green bond, what is a social bond. What helped in the past were the green bond principles and social bond principles developed by the International Capital Market Association (ICMA), mainly for the bond markets, and most of these recommendations have been used by issuers to build their own framework based on this ICMA standard, and then that form also then the basis of the most recent issues. There have also been other principles published in the past, but the more prevailing set of rules is still the ICMA green bond principles or social bond principles. There have been no similar standards for retail structured products within the EU. Currently, we will likely see going forward developments in that direction as well when the structuring of structured products in terms of sustainability becomes more clear. Next, I want to give you an overview about the upcoming regulation here in the European Union. And as I mentioned before, it is a really intense regulation that is coming up. Based on the action plan, what has already been published and is coming into force is the so-called disclosure regulation. I will come to this, what this means in detail later. Then there has been the low carbon benchmark regulation. Upcoming, it's in final form, but not yet published in the official journal, is the Taxonomy Regulation. We will see amendments to MIFID II with regard to investment advice and investment services with regard to sustainability considerations. And going forward, it is anticipated to have in the EU a green bond standard, an EU regulated green bond standard, and an EU Ecolabel, which then you can use to label your product as being sustainable. And there are also other discussions. So sustainability captures many regulations. We will also see changes likely in the capital requirements in the EU, but also with respect to other risk regulations for banks when it comes to sustainability risk with respect to the businesses of banks. And all of this will accompanied by many level 2 measures, how we call it, in Europe. So it's delegated regulations that supplement these main regulations. And as we have seen it in other environmental-based regulations so far in Europe, these will be very detailed and likely very complex. And for many of these level 2 measures, I want to mention there are already consultations going on. As I mentioned before, the overall basis was the action plan by the European Commission. And I think what is quite important here to note is that they see an investment gap that they estimated at €100 to €270 billion per year. That must be realized by the private market in order to finance the sustainability goal. So it's more than €1 trillion in the decade that is needed to finally finance a change to more sustainability and to a climate neutral continent. That the aim is to be climate neutral by 2050. So I want to briefly go to the main regulations that are currently the basis of sustainable finance, and the most important one is the Taxonomy Regulation. It's not yet published, but it's in an agreed final form, and this is the basis of how to decide what is a suitable what is a sustainable environmental sustainable investment going forward. This sets the parameters that on all financings have to be measured against. And this relates to a term of economic activity that must be environmentally sustainable. And this test this requirement comprises 3 elements. First of all, the activity must substantially contribute to one of the 6 defined environmental objectives. You can see this in the boxes on the right side on my slides, like, for example, climate change mitigation or climate change adaptation. Then whatever this objective relates to, it should not significantly harm any of the other 5 objectives. Yeah, it should not just go in one direction and thereby harming the other objectives. And there is also kind of an analysis that will be used to define which of the whether this do not harm test will be completed or not. And then there are a couple of minimum safeguards that need to be met. This only relates at this point in time to environmental sustainability. So what will be in the future in the economic activity that is social is still to be decided, and there's not yet a regulation for that, but it will come up in the future. All the details regarding what is an economic activity that is environmentally sustainable will be further clarified in a delegated regulation, and for that purpose, a technical expert group has been appointed by the Commission that already gives a lot of suggestions how to implement the environmental objectives into a more detailed law. Currently, there are many sectors that will be analyzed and screened, and to see what is actually where are activities that are subject to these sustainability measures in order to bring to improve climate change. On the next slide, you see how the technical annex to this expert group report shows in what detail the thinking goes. Yeah, and if you see with respect to a climate change adaptation object. What measures will be here used to see whether an adapted activity is finally sustainable or not, and what has to be done in order to decide whether it is a sustainable contribution to a climate change adaptation. So from this slide, you already can see that it will be very complex and detailed when it comes to the implementing laws. So what is the scope of the taxonomy regulation in detail? First of all, it relates to it's the basis for all other regulations that will be implemented with specific areas. For example, the non-financial reporting directive, which requires non-financial companies to disclose non-financial reportings, and this non-financial reporting directive will be amended going forward to also include sustainability-related disclosures by companies, or, for example, the disclosure regulation that I will, with regard to financial products. Who is addressed by these regulations? First of all, the EU and member states. With regard to all acts that will be implemented with regard to sustainability in the future, but also financial market participants with regard to financial products or financial advisors under the disclosure regulation. What will be regulated in terms of financial products? You see it on the slide. It relates a lot to portfolio management, funds, IES, pension products or pension schemes, because they invest in companies and then can therefore also create the financing, the funds to finance the change in terms of sustainability. It also relates to disclosures, and these disclosures will have to be made in pre-contractual documentation, investor documents that will be handed out, or disclosures on websites to make it transparent to all kinds of investors, and there will also be periodic reports. When will this come into force? So the adaptation starts in 2022 for other with regard to the climate change mitigation and adaptation, and for other environmental objectives in 2023. It's important to note that this information then relates to activities in the financial year of 2021, so it's not so far away. The disclosure regulation is then the first implementing regulation, so to say, with regard to the taxonomy requirement, and it relates to financial market participants and financial advisors in relation to information that will be given with respect to financial products. And all these disclosures will have to be made either depending on what is the requirement on websites, in pre-contractual disclosures, or in subsequent reports. The transparency obligations under disclosure regulation is either product related, so it means that with a certain product, a disclosure, if it's sustainable in the meaning of the taxonomy regulation, a certain disclosure is then required by the disclosure regulation. But it also relates to the process of the financial market participants or the financial advisors. For example, they have to. This is Article 6 of the regulation. They may have to make clear, in, for example, in pre-contractual disclosures, the manner in which they take into account sustainability risks of an investment decision and how this sustainability risk will finally impact a return on the financial product which they make available. This already makes clear that this is a complex question that has to be addressed going forward by producers but also advisors of financial products. Investor protection is very key here. Yeah, it is important to reduce the information asymmetries between end investors and producers and advisors when it comes to the question what is sustainable and whether it meets the preferences of an investor. The disclosure regulation also captures indices and requirements that have to be met if a particular index is used that is sustainable. And also here disclosures relates to the sustainability impact, for example, of and the environmental or social characteristics of an index. Another regulation that is relevant for structured products is the amendment to the European benchmark regulation that is called low carbon benchmark regulation, which also tackles the upcoming numbers of new indices that have an environmental topic and that label themselves as a low carbon indices. As there is not yet a standard, it was important for the EU to create that standard. So they developed two new kind of sustainable indices in that regulation that are called the EU climate transition benchmarks or the EU Paris aligned benchmarks. And both of these indexes are subject to strictly regulated transparency requirements, and also the minimum requirement for the methodology of those indices will be provided in that regulation. The overall aim is that there is a suitable and a trusted basis for investors to decide whether an index is a climate or a low carbon index in the meaning of the regulations, to give some more details to a label going forward when such an index is used. And the original implementation, and then in addition for all other indices, another obligation has been introduced. So even though it's not a sustainability index, it is important in benchmark statements that it needs to be described whether ESG considerations are used or whether they are not used and how they are used. And this transparency obligation would normally come into force in end of April, but as the level 2 measures are not yet in place, we have seen the very first no action letter by ESMA on end of April postponing the application of this requirement. What is coming next? In Europe, I mentioned it already, there should be an EU green bond standard coming up and an Ecolabel for financial instruments. The first one related to mainly corporate bonds, but it could also, we will need to check that used going forward for structured products. The second one for all other kind of financial instruments, but currently the suggestion does not cover structured products, but we will likely see some discussions here that this label system will be should also be used for structured products going forward. And finally, there will be an amendment. There will be an amendment coming up to MIFID II, requiring requiring with regard to the distribution of financial products, the investment firms that are acting as investment advisor to portfolio management to ask clients for their ESG preference and also to offer to take into account ESG considerations in their services. In particular, if clients are asked for the ESG preference and they said, yes, I do have an ESG preference. In that sense, we will also likely see a change to the European target market, and the German industry, for example, has already developed some kind of answers to the upcoming target market standards and developed two kinds of sustainable product types. The first one is called the ESG products, and the others are ESG impact products. And the link here relates to the disclosure regulations under Article 8 and Article 9, whether it's a product that just promotes environmental or social characteristic or that has an direct investment objective with regard to a sustainable economic activity and funds such an activity. So what does it mean for structured products? As I mentioned before, the main important change at this moment is the MIFID II change, because the Taxonomy Regulation as well as the disclosure regulation does from their text not apply to structured products as such. They are mainly related to funds, for example, but not yet to a bond that includes a derivative. Or a note that includes a derivative component. If under the MIFID II regulation, then investors will be asked whether they have an ESG preference, and they say yes, and they want to invest in a structured product, then going forward, an investment advisor must have a structured product in place to offer it to an investor if they ask for an ESG preference. This will result in an indirect motivation of structured product issuers to provide that growing market with products, because if they're and also investment advisor will ask for that kind of product if investors finally ask for ESG or mention an ESG product as preference, because then there must be a choice to invest in such a product. And how will a structured product then look if it's a sustainable product? This finally then will redirect to the taxonomy regulation, even though it's not yet, it's not directly applicable, but it's the overall basis to measure financial products in terms of sustainability, in particular, the ones that are covered by the taxonomy regulation. In order to have a equivalent standard, then here this might require that structured products issuer voluntarily adhere to the same standards than other financial products. And how will structured products look like? I mean, the most important element would be to have a kind of a financing element, so a use of proceeds that creates a financing of a sustainable economic activity, similar to a green bond under the green bond principles. But there can also be new voluntary industry guidelines going forward. More importantly, is that a financial product will also become automatically, and a structured product also may become automatically considered sustainable if the issuer itself demonstrates that 50% of its economic activity is sustainable. So if structured products issuers going forward in the future are sustainable, then this would also mean that their products will be sustainable within the taxonomy regulation. And there are also possibilities for the called promoting instruments, that they become sustainable instruments if they use some kind of techniques that comply with the taxonomy regulation. And this could also mean using an index that is in line, for example, with the benchmark regulation if it's structured in the together structured in the sense of the taxonomy regulation, that product can then be sustainable pursuant to the taxonomy regulation. So I'm ending with a short outlook on further development. So after this proposed European Green Deal, it was mentioned that a EU climate law shall be coming up and implemented going forward. And we also might see an increasing interest in carbon as a commodity going forward. And as I mentioned before, also the non-financial reporting directive will be amended. So with all this information, I conclude the first part of my presentation, and I'm now handing over to Mr. Scheuble from Solactive to give an overview of what index providers are doing in connection with these developments. Thank you very much.
Perfect. Hello to everybody. So very, very quick introduction. My name is Steffen. I'm the CEO and founder of Solactive. And for those who don't know Solactive yet, just 30 seconds. Solactive started back in 2007. We calculate indices for our clients. The big differentiation between some of the big companies that you might all know, like MSCI, S&P, and so on, we consider them as strong brand managers. Solactive has a very IT-driven approach, so we started and are focusing a lot on IT efficiency and cost efficiency for our clients. That is probably the biggest difference. Some of the numbers you see here on the slides, so Solactive has really grown substantially in the last couple of years. If I'm looking into some of the more practical aspects in the whole index business. If I'm looking back to 2008 and 2009, that was the first initial years of Solactive. At that time, we've already launched the first indices linked to ESG related topics, indices around governance and indices around reputational risk with a Swiss counterparty called RepRisk. We've launched in total 6 indices. The 6 indices collected aggregated volumes of around 100,000 euros in total. So these indices don't exist anymore. It was substantially too early to launch indices at that point of time. And if we are looking now 10, 12 years into the future, now to 2020, I guess the whole topic of ESG has fundamentally changed in the perception, has fundamentally changed in the appetite of investors, and it's really a new reality. For quite a long time, we've always told that in ESG there were more talks than assets. So at the end, a lot of people are talking about ESG, whilst the amounts that were really invested in ESG strategies were quite limited. I guess that has really fundamentally changed in the last couple of years, and we are clearly seeing flows all over the world into ESG-related products. If we are looking into the practical aspects of how does it at the end work, if an index provider is launching an index linked to an ESG strategy. What I'm always saying is, indices are in many, many cases constructed like an Excel spreadsheet. An Excel spreadsheet where you've got different data points that you incorporate in the index construction. And then if you're using an Excel spreadsheet, you can filter, you can sort, you can rank. That's at the end what you're doing. ESG indices are nothing fundamentally different. What you do usually within ESG indices, you start with the starting universe. So you want to use, for example, global developed market stocks. You want to use European stocks from the Eurozone. That is the starting point. Then you apply a selection or filter that you just say, and we'll come in a second step towards that, where you just say, I'll screen certain companies out of the starting universe. And last but not least, you come to the weighting scheme, which can be very simple, market cap weighted, equal weighted, or you weight in terms of a certain factor. For structured products, quite important. Volatility for structured products, quite important. Dividend filters, that is the last and final step. In the ESG space, you've got different approaches towards how you select your index components. And we'll find somebody has moved. I don't know if you can still see the screen. On my screen, I cannot see anything anymore. Let me just see. Let's see where it is. I cannot see the screen anymore. There it is again. So if we are looking to the right side, we see the 4 fundamentally different approaches towards how you screen your components. Option number 1 is the positive screening, where essentially you just say, I'll keep the really, really good companies in my index. So at the end, often you screen out 70, 80% plus of the starting universe, and you only keep the really good companies. We are going to option number 2, negative screening. That is at the end, the screening where you take out, I'm always saying a little bit simple, you take out the really bad companies. You take out the companies that are at the end, not compliant with very basic assumptions like you want to exclude child labor, controversial weapons. These are usually the screens that you apply. So that is what we call the negative screening. The best-in-class approach number 3, is at the end that you take out of specific sectors only the really good companies, whilst you screen out the really bad companies. So at the end, the best-in-class approach has as a result that you still can have fossil energy companies in your index, but you've got the better ones and the worst ones you've screened out. The 4th, last but not least approach is the approach of integration. Integration is something that is quite important all over the world, which means, and this is for sure driven by a lot what the biggest Japanese pension fund, GPIF, mentioned. They don't want to screen out companies because they still want to vote and engage with the companies because they still own. So what you do with an integration approach is you reweight the different components and you overweight the good companies, you underweight the bad companies, but you are still invested in all of these stocks. Very important if we are looking to the structured product business is what is happening after you've done the different screening approaches. And I guess it's really relevant that the structured product business has some really important requirements. If you're launching capital guarantee structures, you want to have indices that tend to have a low volatility, that tend to have a high dividend in comparison to the benchmark. So all of these screens could actually come on top of the ESG screening. Perhaps 1 or 2 just really practical aspects what we are currently seeing these days. A lot of structured product issuers currently have very big difficulties around dividend indices and dividend forecasting indices because essentially we've seen all over the world massive and substantial dividend cuts. So one of the features that is currently gaining a lot of popularity is the topic of synthetic dividends. It can be really applied in 2 different ways. Synthetic dividend as a percentage deduction of the index level, option number 1, or a synthetic dividend in terms of decrement index points, so you deduct specific index points throughout the life of the index. So that is essentially the different approaches towards ESG indices that we can really see all over the world. If we are looking into the evolving landscape and what is it really happening with assets, I'll keep it here really short and simple. I guess what we've all notified in the last couple of years, that at the end the sentiment towards ESG has fundamentally changed in the last couple of years. The change is really visible to many of us. So if I'm traveling the world visiting clients, then at the moment you don't have any conversation where ESG is not really a topic. And it doesn't matter if we are talking about Europe, where ESG has for sure substantially progressed in comparison to the US. It's really a topic that is relevant all over the world. And I guess that is something to me that is very, very interesting, because the perception towards ESG has really changed. In the old times, people were really having the view that if you invest ESG compliant, then at the end you lose performance. That is obviously not true. There are various studies around the performance of ESG-related indices. And I guess once that perception has changed, you really see a substantial growth in the interest of investors. Let's dive a little bit into the real aspects of what really drives at the end the demand. I would like to differentiate there very quickly between the European Union and the United States. And I'll keep it here very, very short. We've heard a lot from the previous presenter. Let's dive into the European Union. Of course, you've got a substantial regulatory initiative in many, many different aspects all over the world. So I guess that is something that we currently don't see to such extent in the United States. What is really important if we are looking into individual countries, then I guess what we have notified that it is really important what the biggest pension funds in the corresponding countries are doing. We've here listed in the United States different pension funds like CalPERS. They are actively looking and embedding ESG factors into their investment decisions. And obviously that is driving a lot of the additional demand that we are seeing from countries like that. We are seeing a lot of appetite in various Asian countries. We've seen initiatives from GPIF in many different aspects. We've seen from big Korean pension funds appetites to invest in ESG compliant ways. So I would really say that all over the world, it is really important to dive into the facts what the biggest pension funds are doing, because at the end it is really helping and underpinning the trend to ESG investing. Let's dive into a concrete aspect, into the regulation that comes and will be enforced in the upcoming months and years. We've here listed some of the practical aspects of the climate transition benchmarks and the Paris-aligned benchmarks. If we are looking from top to down in terms of selection, at the end you've got some fundamental simple exclusions. The baseline exclusions are the controversial weapons I mentioned, as well as social norm violators. Then you've got a clear differentiation between the climate transition benchmark and the Paris-aligned benchmark. Climate transition benchmarks have got no exclusions of certain activities, whilst the Paris-aligned benchmarks are taking out various activities. The biggest ones for sure, oil and coal. I guess that is something that is quite standard all over the world. But you've got also certain exclusions in the carbon intensity space and natural gas. Next steps will be the constraints that we are seeing from the regulatory regime. A very interesting aspect is at the end that you don't exclude the high climate impact sectors. The regulation clearly wants to have a regulation where you invest in all different, let's say, activities, and that you really push for a change in these industries. That is, I guess, something that might look a little bit surprising, but at the end, it's something that is really, really relevant from an index construction perspective. The two differences between climate transition benchmarks and the Paris-aligned benchmarks is the carbon intensity reduction. Climate transition benchmarks less strict, so at the end you need to reduce the carbon intensity scores by 30%, but for the Paris-aligned benchmarks it's a lot more. You need to reduce by 50%. Last and also very important factor is the year-on-year self-decarbonization. That is a feature in the index construction that is really relevant because at the end you need to reduce the carbon footprint of for at least 7% in average per annum during the lifetime of such an index. So at the end, as it is okay to produce today a certain amount of carbon emissions, you need to reduce that footprint over time by 7% per annum. So that is the big regulation that will come into place in Europe. I guess all of the index providers globally are currently working on various concepts. Due to the relatively strict regulation, you've got not the biggest flexibility. So at the end, all of the big index providers are currently working on concepts or have launched concepts. So it's something that will be for sure very, very important in the upcoming years. Let me finish with the last slide and the last impressions, what is really happening these days. We are looking into the ecosystem. Then indices, on the one hand side, is of course something that is quite relevant. All the big index shops are doing currently a pretty good business in the ESG space with all the different features and characteristics of the new index launches. But it's not stopping there. What is currently really happening is that investors all over the world are diving into, let's say, additional areas. One area that is quite important is voting and proxy voting. So at the end, how do you exercise your shareholders' rights during the shareholder meeting? You've got different philosophies there. You've got the topic of engagement, that you're actively trying to change the company. You've got the real voting, where at the end you can, for example, vote against the management board if you've got an index with a management board, or if you've got a company without a climate strategy. All of these voting activities are becoming more and more important. So we see that the relevance of these areas are increasing, and that is something that is very relevant. Last but not least, we've got the different reportings. I guess we've heard already a lot that at the end, one area that is really relevant is the topic of transparency towards investors. And at the end, the regulatory regime in Europe is pushing hard to this transparency. So that is something that we'll see in the upcoming years. To finish the presentation, my personal view is we will see a big trend in the upcoming years, followed by a lot of asset flows into the different aspects. It has already changed in the last couple of months and years. That will fundamentally change the way of how people invest. We've got an increased acceptance of investors to invest in an ESG compliant way. For structured products, we've got all the different features that are really relevant, from high dividend, low volatility, and so on. So the different optimized versions. And I guess that will be something where hopefully the whole ecosystem, the whole industry will really contribute to a fundamental change of the global society going forward. Thanks a lot.
Thank you, Steffen. This is Brad Berman at Mayer Brown in New York. And first I would like to read the CLE code, which is 05MBSP20. please include that code on your affirmation form. Both the affirmation form and the evaluation form are found in your resources widget on the screen. I'll read the code again, 05MBSP20. And just a reminder, if your slides appear to be frozen, just refresh your browser on the screen. So anyways, in the U.S. here, what we have is essentially there has been a lot of focus lately on what ESG really means and what the effect is. And just very recently, and what they're concerned about really is deceptive advertising. The SEC's Office of Compliance, Inspections, and Examinations, that's the OC, just came out recently with their 2020 examination priorities letter. And there, speaking to registered investment advisors, they said they had a particular interest in the accuracy and adequacy of disclosures provided by RIAs, offering clients new types of emerging investment strategies, such as strategies focused on sustainable and responsible investing, which incorporates environmental, social, and governance ESG criteria. Now, this is one of the many things that has been spoken on this recently by the regulators. There are varying viewpoints within the SEC. As you can imagine, there are two camps on this. SEC Commissioner Hester Pierce in June 2019 made a speech. You know, she's mentioned self-identified ESG experts producing scorecards and ratings with no precise metrics and lots of judgments. Public companies bombarded with ESG surveys, some with hundreds of questions using the company's resources in order to respond. And others are producing ESG ratings without contacting the company at all, basing the results on misinformation. And this is a real concern because these scores and ratings that are produced by these kind of groups, there's no standard of metric really for what they're doing. That's the problem. And these ratings affect whether and how companies are included in ESG-related indices and funds. You know, asset managers use these ratings to recommend buying and selling shares, and there's really a concern that it's not uniform, and the amount of time a company has to spend responding to some of these surveys is huge. Also, now just last week, the SEC Investor Advisory Committee recommendation, and this was something kind of on the other end of the spectrum from someone like Commissioner Pierce. This was the Investors Owners Subcommittee of the SEC Investor Advisors Committee's recommendation relating to ESG disclosure just on May 14th. And what they acknowledge there's a patchwork nature of current ESG disclosure outside of the U.S. and a lack of clear disclosure obligations in the U.S. And there's a plethora of ESG data providers in the U.S., all with different standards and criteria, and they're creating a burden on companies with their questionnaires and response requirements. Their recommendation, I mean, they made a number of them. Basically, they're saying, let's grab the bull by the horns, take control of this before, for example, in the EU, it gets all organized and we'll just have to comply with that because that's what the market is doing. So they said the SEC should begin in earnest an effort to update the reporting requirements of issuers to include material, decision-useful ESG factors. And a couple points on this. One example in the footnotes, and I think it was of this announcement, they said, you know, one issuer was responding to a survey. They said they had a practice of doing something one way. The ESG rater gave them a bad rating because they didn't use the word policy instead of practice. So that's kind of what issuers are facing. In this recommendation, it's important to note they use the word material, decision useful ESG factors. And that's really the key we're going to see is materiality versus whether the SEC should be prescribing a set of disclosure requirements relating to ESG, and we'll see where this ends up. Now, interestingly enough, over the past year, the SEC has talked a lot about indices. Not a lot in comparison to saying nothing for years and years. And they've said a number of things about indices, and this would all apply to an ESG index. For example, in November 4th, 2019, Chair Clayton, he questioned whether investors and their advisors understood how indices are constructed from a technical perspective, the opportunities and risks of an investment referencing the index, and the types of key value adjustments the index administrator may make, and including what type of companies are included. Then he kind of threw off a line. He said, do you think more disclosure should be encouraged or required? Basically saying, should we have some regulations on indices? That's quite significant. Dahlia Blass, she's Director of Division of Investment Management, in her speech, and this is in the context of funds linked to indices in emerging markets, she suggested adding the following risk factors, and these all could easily apply to ESG. What are the risks in using unreliable or outdated information when assessing if a constituent should be included in the index? What if the issue is not just the quality of the information, but the index provider has access to partial or limited information? And what are the limitations, if any, in assessing the index provider's due diligence process? So these concepts apply to any index, including ESG. Another very significant statement about ESG was recent comment proposal on what they call the names rule, which is Rule 35D1 under the Investment Company Act of 1940. And this applies and this has to do, of course, with 1940 Act registered funds, mutual funds, UITs, and such. As a general matter, the rule requires a fund to invest at least 80% of its assets in the manner suggested by the name. In other words, what's the fund doing with the money you gave it to buy assets? Is it investing 80% of it in what you thought the fund was? The rule doesn't apply to fund names to describe a fund's objective, strategy, or policies, but regulation of fund names is intended to address concerns that certain fund names may mislead investors. Now, the SEC stated a number of funds with investment mandates that include criteria that require some degree of qualitative assessment or judgment of certain characteristics, such as funds that include one or more environmental, social, and governance-oriented assessments or judgments in their investment mandates is growing, and these funds often include these parameters in the fund name, and the staff observed that some funds appear to treat terms such as ESG as an investment strategy, which wouldn't be subject to the rule, while others appear to treat ESG as a type of investment that's subject to the rule. So there's a concern with, also they mentioned concern with misleading index names. So constituents of indices underlying a fund may not always be closely tied to the investment suggested by the fund's name. That raises questions under the rule when the fund name uses the name of the index. So again, think of an ESG index, and they're raising concerns about that. So in their request for comment, they specifically asked whether the rule should apply to terms like ESG or sustainable. And they asked, are investors relying on these terms as indications of the type of assets in which they invest or don't invest? Is it their investment strategy? Do the fund's investment objectives include non-economic objectives or any combination? Should the rule impose specific requirements on when a particular investment may be characterized as ESG or sustainable? And if so, what are those requirements? And then they asked, should the other limits, for example, ESG, environmental, social, and governance, do you have to hit all three in order to use the ESG term? For funds that currently treat ESG as a type of investment subject to the rule, how do those funds determine whether a particular investment satisfies one or more ESG factors? And are these determinations reasonably consistent? So that goes to them looking at ratings. How good are the ratings? So there's an issue there. If ESG is treated as a strategy, of course, it's not subject to the rule. And then, they're saying, should the rule require funds using these terms to explain to investors what they mean? Last big item on here was recent proposal to update Regulation SK. Briefly, that governs disclosure and registration statements and reports filed under the Exchange Act. On January 30th of this year, the SEC proposed changes to the MD&A disclosure rules and the financial data. And what the proposal does in broad outline is keep to a principles-based approach rather than prescribing specific items to be disclosed. And of course, there had been a lot of comments and a lot of noise before this about putting in required line items about climate-related factors. So the reaction, basically, they kept to a principles-based rather than prescribing specific requirements. Again, Hester Pierce, she was pleased with this. The MD&A provides a narrative explanation of a company's financial statements. This allows management to disclose information material to investment decisions. There's a concern that if we start prescribing everything and what we think is valuable, the materiality itself, the whole concept is going to be degraded, that we face repeated calls to expand our disclosure framework to require ESG and sustainability disclosures, regardless of materiality. We said materiality does not turn on what's important to non-investors or to select group of investors motivated by objectives unrelated to or only tangentially connected to their investments' profitability. Strong statement from Allison Lee. Another viewpoint, the proposal is notable. What it doesn't do, make any attempt to address investors' need to standardize disclosure on climate risk. And Chair Clayton, on the same day, he said, as a standard setter, I should not be substituting my operational and capital allocation judgments for those of issuers and investors. We're running out of time, so I think that's about it. But you can see that the SEC is focused on it. There's a concern, again, it kind of goes back to deceptive advertising and a general concern when telling issuers what they should disclose, or trying to keep to what's material and sticking to that principle rather than coming up with a laundry list of, prescribed disclosures for the cause du jour. Anyways, I want to thank you all for attending today. Let's see, I'm going to this CLE code here one more time, 05MBSP20. Thank you very much.